Hello friends, lovely greetings of the day to all of you. So here I, Kunal Nagpal, welcome you once again to our great economic session. Dear friends, we know that India advantage is that steady rise in the foreign direct investment and world is confident of the India growth story. That is, in 2014-15, it was nearly $45.15 billion, and now, that is in the year 21-22, it rose to $84.84 billion. That is from $45.15 billion to $84.84 billion. That is 88% increase. So the government reforms have boosted the investor confidence in the India growth story with an 88% rise in the FDI in the last 8 years, hence making India the global investment hotspot. So dear friends, on this note, I would like to begin today's discussion wherein we will basically discuss that how the RBI governor, Mr. Shaktikant Das, presents and justifies the recent repo rate hike to 35 basis points. Further, we will also try to study that how the Forex flows help to tackle the Indian economic situation of the current account deficit challenges. Next, we will also consider the World Bank report wherein it states that India's heat waves could break the human survivability limit. So, on this note, let's begin today's discussion. The Reserve Bank of India recently on Wednesday, that is on 7 December 2022, raised the policy interest rates for the fifth time this year, but by an expectedly smaller quantum, with inflation seen to have possibly peaked. At the same time, the central bank pledged to maintain tight monetary conditions since the easing of price pressures would be grudging and uneven. So an evolving adverse global economic scenario led the RBI to whittle down growth forecasts even while it retained inflationary expectations amid visible easing in farm and commodity price pressures. It was also influenced by the international supply chain readjustments and the changes in the financial conditions in the aftermath of liquidity drainage. The repo rate at which the RBI lends to banks was raised 35 basis points to nearly 6.25%. Other rates moved in tandem by similar magnitude. A basis point is basically 0.01 percentage point. The governor Shaktikant Das said the central bank would remain vigilant to ensure that inflation comes back within the upper tolerance limit of 6% and then to the 4% target gradually. The RBI last month wrote to the government explaining why it failed to contain inflation below 6% as per law after it breached the limit for the 3 consecutive quarters. The battle against inflation is actually not over yet, Mr. Das said after the policy announcement. The pressure points from high and sticky core inflation and exposure of food inflation to the international factors and weather-related events do remain. While being watchful of the impact of our earlier monetary policy actions, we will keep urgent eye on the evolving inflation dynamics and hence be ready to act. The 6-member Monetary Policy Committee, that is the MPC, voted 5-1 on the repo rate increase, with J.R. Verma voting against. The external member, Ms. Ashima Goyal, joined Verma to vote against, remaining focused on the withdrawal of accommodation in the monetary policy. Governor Mr. Das has basically continued to talk hawkishly, said Mr. Aradip Nandi, economist at Nomura Securities. He concluded his statement saying that the future policy action will remain data dependent and will consider the monetary policy tightening already delivered so far. The MPC also continues to remain split, with one dissent in favor of a pause and two dissents against the current stance, suggesting that the rate hiking cycle is nearing its end. Leading the central banks, including the US Federal Reserve, are signaling that they may have to continue their fight against inflation for a lot longer than estimated. But Fed Chairman Mr. Jerome Powell indicated that the magnitude of the interest rate increases may be smaller than the 75 basis points hike at the previous meeting. The RBI is walking the same path. Deputy Governor Mr. Michael Petra said the magnitude of the future increases will be less, but tighter conditions will have to prevail as easing of prices will be grudging and uneven. The ET poll had forecast that the central bank would basically hike the rates by 35 basis points or less. Investor reaction was muted, with the Sensex sliding 0.34% to 62,410.68 and the falling rupee by 0.17% to 82.66 to the dollar. Yields on the benchmark bond were a tad higher at 7.26%. The monetary policy making basically requires the Reserve Bank of India to take into consideration the domestic factors, but in an interlinked global economy, India actually can't remain an isolated island, Mr. Das said. In an interconnected world, we cannot remain entirely decoupled from the adverse spillovers from the global slowdown and its negative impact on our net exports and overall economic activity, said the governor. So, though the impact might be less, but still, India can get impacted. So, we need to be very, very sensible and act proactively. The biggest risks to the outlook continue to the headwinds emanating from protracted geopolitical tensions, global slowdown, and tightening of global financial conditions. With spillovers tightening the Indian economy and inflation spreading to services through food prices are basically easing, the RBI kept its inflation forecast for the financial year 2023 at 6.7% but cut the growth forecast by 20 basis points to 6.8%. The global commodity prices are easing, with Brent crude oil trading at less than $90 a barrel despite the Organization of the Petroleum Exporting Countries, that is OPEC, and Russia determined to restrict the output. The farm prices have also eased since the arrival of fresh harvests. Mr. Das said the currency slide has basically halted and the central bank has enough reserves to shore it up. The current account deficit is actually swelling and is likely to cross the 3% of the GDP mark, but may be manageable. The size of the Forex reserves is actually comfortable and has also increased, said Mr. Das, referring to their increase of nearly $24.5 billion as on October 21. Hence, resulting to the current figure of $561.2 billion on December 2, covering about 9 months of the projected imports. Further, India's external debt ratios are quite low by international standards. The minutes of the MPC meeting will be published on December 21. The next meeting of the MPC is basically scheduled for February 6 to 8. Hence, the key highlights of the governor's assessment can be as follows. The current account deficit is actually manageable. The Forex reserves up $36.7 billion since October. External debt ratios low by international standards. Economy holding on and doing well in a world of slowing growth and recession fears. inflation coming down, but no room for complacency. Need to be extremely watchful and act whenever necessary. RBI ready to inject liquidity if need arises. Story of rupee is one of resilience and stability. RBI remains committed to act to the prevention of excessive volatility aspect. Hence, I find this in-depth analysis really useful and quite relevant. Now, next topic of today's discussion is the Forex flows help India to tackle with the current account deficit challenges. The fund flows into India, billed as the world's fastest expanding major economy, could help New Delhi weather the challenges posed by the widening current account deficit. Reserve Bank of India, that is the RBI Governor, Mr. Shaktikant Das, said. In the external sector, slowing global demand is weighing on merchandise exports. At the same time, the impact of the terms of trade which shook due to the war in Ukraine is gradually getting normalized. Governor Das said, underscoring the fact that India has some innate buffers. The current account deficit is exposed to cross 3% of GDP in the current fiscal, but the RBI expects the situation to be manageable. Growth in services, exports, mainly contributed by software, business and travel services, remained robust at 29.1% in April to October 2022. Remittances are rising fast with a pickup in activity in the Middle East. According to the latest update of the World Bank, India's remittances are estimated to grow by nearly 12% to $100 billion in 2022 from $89.4 billion in 2021. Remittances coming to India rose by 22.6% year-on-year in the June quarter. The net balance under services and remittances remains in large surplus, partly offsetting the trade deficit. Consequently, even if the current account deficit is higher than 2021-22 estimate, it is actually eminently manageable and within the parameters of viability, Mr. Das said. Forex inflows through various channels are also picking up, Mr. Das said. The net foreign direct investment rose to $22.7 billion during April to October 2022 from $21.3 billion in the corresponding period last year. So this is really encouraging. The foreign portfolio flows have resumed in recent months and were positive at $11.8 billion from July until December 5, led by equity flows. The ratio of reserves to total external debt has increased to 95.5% in June 2022 from 71.3% in 2012-13. The debt service ratio, that is the principal repayments and interest payments as a ratio of current earnings at 4.9% in June 2022 was lower than 5.9% in 2012-13. Currently, it is actually one of the lowest among the emerging market peers. Hence, my dear friends, this entire statistical analysis is actually quite relevant again and is quite insightful because it helps us to basically come to the point that why India has been outperforming its peer countries. Hence, the overall improvement in the holistic scenario, if we consider the whole situation of the improvisation of the economic parameters, is actually quite encouraging. Next, let's discuss the basic World Bank report, which suggests that India's heat waves could break the human survivability limit. The severe heat waves responsible for thousands of deaths across India over the last few decades are increasing with alarming frequency, and soon the country could become one of the first places in the world to experience heat waves that break the human survivability limit, according to a new report by the World Bank. So this is actually one of the aspects that requires great attention of the concerned authorities. The World Bank report, titled Climate Investment Opportunities in India's Cooling Sector, said the country is experiencing higher temperatures that arrive earlier and stay for longer. In April 2022, India was plunged into a grip of a punishing early spring heat wave that brought the country to a standstill, with temperatures in the capital, New Delhi, topping 46 degrees Celsius, that is 114 degrees Fahrenheit. The month of March, which witnessed extraordinarily high peaks in temperatures, was the hottest ever record, it said. The report will be released during the two-day India Climate and Development Partners Meet being organized by the World Bank in partnership with the Kerala government here, predicting that the heat waves is a situation in India which could break the human survivability limit. It said the recent heat wave supports what many climate scientists have long cautioned about with reference to the rising temperatures across South Asia. In August 2021, the sixth assessment report of the Intergovernmental Panel on Climate Change, that is IPCC, warned that the Indian subcontinent would suffer more frequent and intense heat waves over the coming decade. The G20 Climate Risk Atlas also warned in 2021 that the heat waves across India were likely to last 25 times longer by 2036 to 65 if the carbon emissions remain high, as in the IPCC's worst case emission scenario, the report said. So, my dear friends, this basically helps us to analyze the current scenario in which we are paying a lot of emphasis to the renewable energy sector segment. So that is actually a very, very important topic to be considered, and we need to give a lot of weightage. We need to reduce the total emissions of the greenhouse gases. Hence, we need to consider the alternative fuels, that is the non-fossil fuel energy sources, in which we can take into consideration the electric technology, that is the EV technology, hybrid technology, solar technology, tidal energy sector. Then we can also consider the hydropower sector. We can also consider the overall gaseous sector, in which we are noticing the basic segment of the natural gas and the hydrogen-based ecosystem concept, which is actually the need of the hour, and hence our respected Prime Minister has basically estimated that by 2030, that is within next 8 years, we would be able to achieve 500 gigawatts of energy generation through the renewable energy through the renewable energy sources. As of now, the figure of the statistics of this particular aspect is only 57 gigawatts, but we need to increase it to nearly 500 gigawatts in next 8 years. So we need to put our heart and soul into this particular aspect. That's the need of the hour, and the World Bank report is basically a caution, or is basically an alarming signal for us to pay due consideration to this particular aspect. It also warned that rising heat across India can actually jeopardize the economic productivity. Up to 75% of India's workforce, or 380 million people, depend on heat-exposed labor, at times working in potentially life-threatening temperatures. By 2030, India may account for 34 million of the projected 80 million global job losses from heat stress associated productivity decline, the report said. Hence, we need to be very active in the domain of generating energy through the renewable sources or the non-fossil fuel energy sources. It further said India showed the largest heat exposure impacts on heavy labor among South Asian countries, with more than 101 billion hours lost a year. So, my dear friends, this in-depth analytical report is basically an alarming signal for us to act very proactively and sensibly towards the attainment of the Sustainable Development Goal number 7. Though we are progressing quite impressively in terms of the attainment of the Sustainable Development Goals as being appreciated by the UNDP, if we draw the comparative analysis with our global peers. But as far as the renewable energy sector is concerned, we need to pay a lot of emphasis because it's the need of the hour. It's the need of the gradually changing climate and the spikes of rising temperatures is basically the call of time to act very proactively in this particular domain. So I hope this insightful lecture session would help you to gain very valuable insights. So, my dear friends, I would be really grateful if you could comment in the feedback section so that we can incorporate your valuable suggestions in our subsequent lectures. Thank you so much. Namaskar. Jai Hind.